Good evening, everyone. This is Alan Wu, Sequoia Lending. Welcome again to our weekly commercial trainings. So today we have a very special guest here to talk about what commercial lending it's all about. For the last whatever weeks, months, years that you have been listening to me talking about commercial fundings, okay? So I think it would be a good idea, not only that you're just hearing from me, but also actually hearing from some of our lender that what are they actually doing? How are they, first of all, why are they in business, right? Now, this type of lender is not like the bank. It's not like Wells Fargo, Chase, and things like that. They are lenders, okay? Their main purpose is not to take your deposit, but their main purpose is to fund projects, whether it's, commercial, warehouse, retail, 1 to 4 unit, mix and fix and flip, things like this. So first of all, why are they in business, right? So what is their business model looks like? And especially in today's market, when interest rate has gone up so much, and how are they dealing with the market? Why do they think that right now is the perfect timing for a lot of investors that is moving over to private lenders like us or commercial lenders like us instead of going out there to get a loan from a traditional mortgage? And what happened? I mean, a lot of us know for a week or two ago, some major bank fell in California. How is that going to impact our lending? Okay. So without further ado, I'm going to introduce a very good friend of Sequoia, also in the personal level as well as the corporate level. We have been working with this gentleman for the last, I would say, for the last 3 or 4 years.
Yep.
Closed a lot of deals. And one thing about this particular gentleman is that he would go extra miles. I'm not just saying that extra mile. I would say extra 2 miles, extra 3 miles, or even extra 10 miles to get things done. And we've been through a lot of dirt. We've been through a lot of city dumps. We've been through a lot of trenches to get things done. So that's one thing about what Sequoia can bring on the table is when you go to a lot of banks and when they looked at the deal, they're saying that, no, the deal does not fit into our box, and they would just shut you off and they just kill the deal right there and then. But however, in Sequoia, lenders like Eric right here, they are willing to go that extra 10 miles to help you to close that deal. So again, without further ado, I'm going to turn the floor to Mr. Eric Shaw, and he is here to talk about, he is from Huntley Capital, and he's the owner of Huntley Capital. We've done a lot of deals with him, so he is here to talk to us what he sees the market and hopefully to encourage us to go out there to generating some more deals. So Eric, the floor is yours.
Well, Alan, thanks so much for having me. This is a real privilege, and it's been a joy working with you. Like you said, we've been through a lot together. I guess first thing, you had a great segue. Commercial lending, I'm sure you guys are familiar with commercial loans versus consumer loans. The types of loans that we're doing with Alan are pure commercial loans. They are also residential loans. There's all sorts of types of commercial loans. The ones that I specialize in are residential loans. So these are going to be on single family, 2 through 4 unit properties, small balance multifamilies, meaning 5 units to 9 or 10 units. So that's the specialty that I have and that we've been working together on. The kind of interesting thing about commercial loans is I wouldn't say anything goes, but a lot of things go. You have a lot more flexibility.
Don't come to work today, girl, so we could be messy.
There we go. Now I'm open. You've got a lot more flexibility in a commercial loan. The reason I bring that up is you're going to find out that, as Alan said, there are some, I was going to say there are never, there are some perfect deals where you'll talk to somebody, they'll have all the money in the world, they'll have 800 credit scores, they will have done 100 fix and flip projects in the last 3 years, and they've got a project that fits perfectly. grab those people and run with them because they don't come around very often. Most of the time, there's something going on. There's some hair on it, as we say. I guess what I wanted to mention is don't be afraid of those. You're talking to people, you're having a conversation. Oh yeah, so-and-so, he's looking at buying a house and he's going to renovate it and he's going to flip it. He's never done it before. And oh gosh, well, all right, I guess I can't do that loan. That's not necessarily the case. So don't self-select anything that you're talking to people about. What I guess the point I wanted to bring out here today is keep your ears open for certain things. You may have conversations with realtors, you may talk to insurance agents, you may talk to, in your neighborhoods. I heard people from all over the country, which is fantastic. Out here in Los Angeles, regularly driving along, you'll see a sign that says, "We buy ugly houses," or, "No questions asked, we'll buy your house." Write that number down and call that person. Those are the types of people that they may not be your client, but they're the ones that are picking up that inventory. They're called wholesalers, if you guys have heard that term. They're people that they'll construct a deal and then they'll turn around and sell that deal to an actual investor, a flipper, to go in and actually do the work. They can put you in touch with these deals. And if you can get in good with somebody like that, they may churn dozens and dozens of houses in any given period of time. So write those numbers down, make some phone calls. Hey, I'm in touch with lenders. Alan can work with you on finding your clients money so that they can buy your project off of you. So in general, what's going on with the markets right now? So it's been a little bit of a turmoil in the last year, let's say. Rates prior to that were down at 3.5%. Everyone was giving money away. It was really easy. Times were good. Prices were going up. Everybody was happy, right? Well, in the last year, things have gotten a little bit weird. You're hearing stories about banks failing. We have Silicon Valley Bank and First Republic Bank, both here in California, going belly up or having to be rescued. So what does that mean? And how does that affect us? Well, oddly enough, that may have given us a little bit more breathing room in real estate because the Federal Reserve over the last 6 months or so has been raising interest rates. So they don't deal with the 30-year mortgage rates and they don't deal with the 10-year treasuries, the long end of the curve, but they do have a direct influence on the short end of the curve. And I'll explain why that matters to us. But basically what the Fed does is they set this borrowing rate at the short end of the curve. And as that increases, they're trying to cut inflation. So inflation's really bad because $1 you make today is not going to be worth $1 tomorrow. And the higher inflation, it's going to be worth less and less tomorrow. So your buying power drops. And the average American whose salary is not increasing quickly, inflation erodes their purchasing power. And why that's important to us in real estate is, housing prices are going up everywhere like crazy. And if people's salaries aren't increasing fast enough, they're not going to be able to afford homes. So the Fed wants to get inflation under control. They're lowering interest rates. They're raising interest rates over time. And rates were too low for too long. And so now we're kind of getting to a set point that makes a little bit more sense. So the Federal Reserve, Chairman Powell just spoke earlier today. He raised interest rates 25 basis points, so 0.25%. So we're now at between 4.75% and 5% on that very short end of the curve. We were at 0 about a year ago. So that tells you how quickly we've increased our interest rates over this period of time. That has started to get inflation under control, which is fantastic. Housing prices have actually the rate of increase in housing prices has decreased. So across the country, where anybody could buy a house and then 3 weeks later sell it for more money, that has started to decline. And so what does that mean? So, as you guys are looking out there and thinking about deals, Investors are looking at, how do I make money in this kind of an environment? So, they're looking at buying houses at a discount more often now than they were before. That's why finding those they call them panda signs, but the we buy cheap houses people is really important, because they're getting the off-market properties. If you're dealing with realtors, you want to ask them about what their pocket listings are, or the really messy house down the corner that they've found the owners for. How do you turn that into an investment, over to an investor, help them get financing, and then they'll turn it around and turn it into inventory. So what happens now is interest rates are rising, right? So that's bad all over. It's bad. However, the long end of the Treasury curve, the stuff that we care about for mortgage rates, is not rising as much as the short end. So as you're talking to investors and the concern is, things are too hard, they're too expensive. Well, not really as bad as they were. And where the bank failures have actually kind of oddly helped us a little bit is it's caused the Fed to slow down a little bit on the aggressive interest rate increases they had been going through. So what does that mean? We bought ourselves a little bit more time. Interest rates right now for our long-term loans, and I'm going to throw out a term and I'll explain it in a minute. We call them DSCR loans, debt service coverage ratio loans, these 30-year rental property loans. Right now, we have a base rate of 6.5%, which is actually right around what the 30-year Fannie rate is. It's not bad. It's called a buy down rate. It costs a little bit of money to get there, but even at no points to the lender, you can get rates at, maybe 7 or so, 7.25, which for an investment property is actually really pretty positive right now. So out there, when you're talking to people and having discussions, you're looking for people that are, and I think Alan in general is not doing loans to owner-occupied properties. These are not, hey, I'm looking to refinance or I'm looking to buy a home to live in. These are, I want to buy a rental property. There are people out there that will buy turnkey rentals, meaning it's ready to go. It was a rental before, it's going to be a rental again. I'm going to buy it. We can lend on those immediately, or on the bridge, or short term, or fix and flip. You guys might watch HGTV shows about that. Somebody goes in, they renovate it, and then they turn around and sell. Well, that's an opportunity to get 2 loans. What's interesting is if you're tied to investment professionals that are doing these flips, these flippers, you can get the loan associated with the original purchase, which is that purchase rehab. And then at that point, they usually sell. And depending on what kind of property is, and if you can kind of think in terms of what are typical investment properties, well, investment properties, rentals are usually in a city. They're usually in an urban atmosphere. They are usually 2 through 4 units, because people don't typically live in a duplex. They might live in half, but by and large, those are investment properties. And if you can get a flipper that is constantly turning those properties over, not only are you lending to them, but then when the person is coming in to buy it, to then rent it out to people, you can do a loan there too. So we can do both of those on both sides of that equation. Couple things. As far as regionally versus nationally, so we can lend all across the country. So it's kind of exciting that you guys are from all over the place. I heard Texas, I heard New Jersey, I heard Missouri, super popular areas. I don't know if there's any Floridians out there, but that's also a really popular place that we're doing a lot of loans in. I know right in Alan's backyard, the kind of Baltimore, Philly area, very popular as well.
A certain time and they get caught.
I'm not sure if you guys, I would put it up. I see a question, and I meant to mention this in the chat. If you guys have a question, throw it up there, and I'm happy to. How much is the maximum LTV for a purchase loan? So the maximum LTV on a fix and flip, so that investor that goes in, buys it, renovates it, and then sells it. If someone's got 3 projects in the last 3 years that they've done a flip, we can lend up to 85% of the purchase, 100% of the rehab, up to 70% of that after repair value, or what the property would be worth once it's complete. So, 85%. So they have to come to the table with 15% on that, and then we'll cover the rest. On the 30-year rentals on these DSCR loans, those we can do up to 80% of the purchase. So, if someone's going to have to come to the table with 20% on those, and I'm going to answer a question you didn't ask, on cash outs. So these are popular as well. Someone may come in and, they've owned a rental property forever. It's appreciated in value. And now they want to take some money out to do whatever. Doesn't have to have a purpose, but maybe it's to buy another property. So you always want to kind of think about, well, someone's like, oh gosh, I want to take cash out of, oh, that's great. I can help you with that. And by the way, what are you going to do with the money? Oh, I'm going to buy another property. Great. Now you got 2 loans you got to work on. But those loans for the cash outs, we can do up to 75%. So it's usually on the cash outs, usually a lower leverage. LTV is loan to value. So how much the loan is compared to the value of the property, lower leverage than on a purchase. Alan, is there anything that I'm missing or anything that we want to discuss?
Let's talk about as a lender, right? So obviously right now the market has changed. Personally, I see a lot of loan officers from real estate agent loan officers that they used to be able to get loans from a traditional bank. Looks like they're not able to get that anymore. And I personally, I feel that many of them is actually coming to our side. What are you seeing as a lender from your end?
Yeah, and that's a good question. So we see a fair amount of drift from conventional loan lenders over to the commercial side for a couple of different reasons, and some of that has been. Sorry, my light keeps turning off, and I keep whatever. So we're seeing some due to for professional investors, they're only allowed 10 loans under the Fannie conventional program. So if you've got somebody that's got, dozens of rental properties, they actually are really excited to talk about commercial loans because they just can't get it Fannie loans anymore because usually they're tapped out. They've gotten all the Fannie loans they can get. They need to come to somebody like us. What's happening now in the conventional world where the Silicon Valley Bank and some of the banking crisis things have happened is it has caused, and I used to work for a bank, it has caused the banks to be more cautious. It's caused lending to certainly not anywhere close to where 2008 was, but banks are really, they're concerned about their liquidity, they're concerned about their capital. And the first thing they do when they get those concerns is they increase the scrutiny that they give to loans. And so they tend to slow things down as far as loans go. So that brings private money, private lending, commercial lending into play. Now, as far as the commercial lending space, we also are not immune to concerns in the market. And I'll say that there are some of my competitors that have closed their doors or slowed things down. So it's nice to be associated with well-capitalized, diligent counterparties. But we have, I would say, as far as kind of flow of loans over the last year, we were, through the moon in most of 2021 and 22. Everything was great. Things started to slow down kind of mid last year. By the end of last year, it was really slow. I think people were digesting what was going on in the market. When rates started to go crazy, Powell was raising rates. Banks were concerned. People had slowed down. They're back. I think this month is expected to do as much volume as probably October or September of last year, which was really a strong period of time. So don't be fooled. it's not everything is super rosy like it was 2 years ago, but people are doing deals. They're out there. Home prices are still appreciating. And even in a decelerating market of home pricing, you're going to find people that need services, like I said, like, cash outs, people that are looking to refinance loans. Those possibilities are there, and they're there all over the country. You didn't ask, but I'll answer a question I was thinking. There are certain pockets around the country right now. So Houston, I think, Oren, you said you're from Houston. Challenging. Home prices in Houston have dropped. We're seeing some concerns. Now, on a long-term loan basis, it's probably not as concerning because you have 30 years. Home prices are going to go up over the next 30 years, right? On a fix and flip side of things, that's when things are concerning. Again, let Alan and I kind of worry about some of that stuff as far as, does this person qualify or not, or what do we need? We'll deal with the underwriting. But just in talking to people, you're going to find people like, oh, it's kind of frustrating, and home prices. Well, what have you found things at a discount? Are you looking for the the underappreciated areas maybe? What kind of renovation can you do to really bring it up to above market? Those kinds of things. There's a question in the chat. Do you charge a penalty for early payment? Sorry, this is driving me crazy. There we go. It's a little bit more light. On the short-term loans, no. In fact, we want you out of there in like a month. So any kind of fix and flip loan, we want that renovation done quickly, because the longer it takes to do a project, the more likely it is that it's going to fail. So challenge there. So no, there's no prepayment penalty. The long-term loans, yes. And the rationale behind that is, the way we can offer rates at 6.5% to 7% is because our investors are going to they have some kind of guarantee, at least, or probability that they're going to get payments over the next period of time. So our best rates are associated with a 5-year prepayment penalty. So it's not a lockout. People can prepay, and over that 5-year period, it declines. So it's 5% of the loan is a penalty in the first year, 4% in year 2, 3% in year 3, et cetera. There's opportunities it's called buying that penalty down. So with a bit of a higher interest rate, you can get a lower penalty. And right now, actually, that option is pretty cheap. A 3-year prepayment penalty right now is only about 0.15% of interest rate increase, or 15 basis points. So every time I'm talking to somebody and they're looking at a 30-year loan, I try to convince them that, look, rates are probably going to get better 3 to 5 years from now. Buy the rate down, pay the extra 15 basis points. It's probably worth it. There we go. Virginia market. Virginia's a big state. I think in general, Virginia has seen some Virginia's good in that it hasn't exploded like a lot of the country has. Just like in 2008 to 10, or I should say 2005 to 8, Vegas, Miami, those areas, Los Angeles, prices went through the roof really quickly, and then they dropped really quickly. Well, we're seeing similar trends here, although less meteoric. Again, West Coast, Boise, Idaho, of all places, went crazy because all of us Californians during COVID said, we're out of here. We're going to leave the city behind, and we're going to go out the woods. And they bought all the houses. Huge developments started getting built. Phoenix, Arizona, same thing. Those are starting to see some really big drops. I'm not seeing that in Virginia. Richmond, Virginia has been a strong market. I've got investors in Lynchburg that have been doing really well. The DC area is always kind of iffy. You have the federal government there that kind of keeps prices propped up. Alan, you probably have a lot more experience being more local than I, but I've seen it be a relatively strong market.
Okay. Eric, let me ask you another question right
Yeah.
here. So, as a lender, I know that you do fix and flips, short terms, multifamily, so on and so forth, and even you do some constructions. what are you seeing? So what do you fund the most? So so that our consultants right here know, what to target.
Yeah. So the bread and butter is really 1 through 4 unit. And when I say 1 through 4 unit, sorry, this is going to drive me crazy. That single family homes, duplexes, triplexes, quadplexes, all day long. Those are super easy. Once you get to that 5th unit and you think 4 to 5 is no big deal, it becomes a very different kind of a loan and a very different program. It's a bit more expensive and a bit more time consuming, and it requires more experience of the borrower. That becomes a multifamily loan at that point. So we're looking for people that have owned multifamily properties, that have professional property management. Either they have a company themselves or they hire out, those kinds of things. But I'm doing probably 80% of now 90% of my business is in DSCR, that 30-year rental loan on 1 through 4 unit properties. And the best properties that I'm seeing right now, again, because the rates are a bit higher than they used to be. When rates are low, it's super easy to get those loans done because, and I'll explain in a minute why, is the 2 through 4 unit. When there's cash flow associated with multiple units, then obviously the income is better. So for those of you unfamiliar, the way the loans are structured for the 30-year rental loans is really, if you think of it, it's income over expenses. So the income is your rent, and the expenses are, it's really simple. It's the principal and interest on the loan, the taxes, and the insurance. And then if there's a condo, the homeowners association. So if the rent covers those expenses 1.1 time, you're fine. You can do the loan, no problem. And if you think about it this way, if your PITI, the principal, interest, tax, insurance payment is $1,000 a month, your rent has to be $1,100 or more. So if that works, great. You can get full leverage as long as you got the right credit score and all the rest of that. So with 2 through 4 unit properties, it's a lot easier to get that done. So if you're looking for a specialty, if you're looking to focus on something, if you've got an area that you live that tends to have more duplexes, that tends to have lower taxes or some kind of low expenses, those are always helpful as well.
Okay, very good. Can you talk about many of our clients keep asking, hey, can I do the loan under my name? I keep telling them, no, you cannot. You have to do it under the LLC. Again, obviously, there's a reason to it.
Yeah.
Talk to us about that.
Yeah. So as a commercial loan, we want to. There's a couple reasons why we can do things a little bit differently than a standard consumer loan. Standard consumer loans, tons of regulations. The OCC, the banking regulators make sure, for good reason, make sure that the consumer is protected. Commercial loans are meant to be to professionals, to professional investors. They're non-owner occupied. And so consequently, we want to make sure that our borrower is an actual entity, as an LLC or a corporation. To Alan's point, I even hate to bring it up, we can sometimes make an exception here or there. Like Pennsylvania has some really strange or expensive mortgage laws, so that transfers, if somebody owns a property in their own name and they want to refinance, if we push them to do it into an LLC, it can be really expensive for them. So sometimes we'll make an exception. Usually it comes with a leverage reduction. So just keep that in mind. But that's a quote unquote downside is, oh yeah, I have to create an LLC, I have to create a corporation. Let's face it, LegalZoom, it's super cheap to do that in most places. California, of course, everything's expensive, but in most places, for $100, you can probably get an LLC put together with all the documentation you need. The benefit to that is it really protects you and the investor because a couple of reasons. First of all, the whole point of it is limited liability, right? If I've got a rental property, I want that rental property in some kind of an entity because, if my borrower slips and hurts themselves, I don't want to be sued, and you can stack layers of protection associated with that. As a lender, the benefit to the investor of having it in an LLC is the loan doesn't show up in their credit report. So think about that. If I've got dozens of properties that I'm renting out under my entities, my credit score is not going to be based on what's going on with those properties. They're just, it doesn't get reported. So that's a definite positive. Now, the credit score is important for us. The borrower, and I'll use that term a little bit more loosely, the guarantor for the loan, they are writing a personal guarantee. They're putting their name on it that says, if you have to foreclose on my property, you have to take it away. If the property's not worth what the loan is, then you can come after me and I'll pay the difference. But let's face it, if our loan is at 80% value, and I mean, it's unlikely that the value of the property drops by 20% in any given period of time. So, but that notwithstanding, so when you're talking to people, if they're like, oh, I don't want to deal with commercial lending, yeah, I have to create an entity and stuff. A, it's not that expensive. B, it protects them. And C, it protects their credit, which is huge.
Absolutely. So there's another question. What is your minimum
FICO.
credit score, FICO score?
So for our, and this changes over time, but right now we're a little bit tighter than we were. Our fix and flip loans, we still can go down to 620. So 620 and above, it's going to have reduced leverage and your price is going to be higher. So, you know, there are consequences associated with a low credit score, but we can do it. On the 30-year DSCR, 680. 680 is our minimum. You know, it was down, we were at 620 for both, but our long-term rentals, we want to make sure that people are, you know, effectively good borrowers over a longer period of time. So we want a higher credit score for that. Oh, and the good thing about the entity is if you, let's say you've got dented credit, you've got a 650 credit score and you've got this rental property. Well, if you bring in a partner, pull someone into your LLC, they can be a guarantor. You can use their credit and you can basically use your experience. So there's a lot of flexibility associated with that. So, you know, that's, don't, again, talking to somebody out there and they're like, oh yeah, I want to do a fix and flip, but man, my credit's only 620. Talk to Alan. There's ways we can work through situations like that.
Absolutely. Absolutely. Yeah. So, ladies and gentlemen, feel free to ask your questions. Eric has
open it up.
Amount of knowledge, so open it up. Whatever questions that you have, probably this is the only time. Okay, he's not going to come back up anytime soon. But while we're waiting for the next questions, back to the credit score. Do you just care about the number, or you actually look at the reports?
Both is the short answer. The numbers, obviously, the number is something you can point to, right? That median score, meaning in a tri-merge, the three agencies, the middle score is the one that we're looking at. The credit report itself is reviewed. The most important thing on the credit report is do they have any mortgages on the report? And have they been late on any of those mortgage payments? Credit card lates, student loan lates, derogatory accounts for your Macy's card, those kinds of things, car payments matter less. Now, if it's pervasive, if there's a lot of red on the credit report, you know, obviously maybe we have a little bit more concern, but by and large, pay your mortgage. It's really what it comes down to. That's because right. We can excuse a lot of other things if there's no payment lates on your mortgage.
Right. Francine, go ahead, unmute yourself.
Awesome. Thank you. Can you hear me okay?
Yep.
Awesome. Thank you so much for being here. We appreciate you so much. And you're going to get a lot of loans now.
Yay.
With that being said, from an underwriter's point of view, I have a question. Now, if there was an LLC and the majority holder of that LLC, if their credit wasn't good enough, and there was, let's say, a second managing member, I would ask them if they could give that managing member more of an ownership, you know, like 51%. And then that way we could underwrite the deal. So, and I heard what you said earlier. for them to possibly add someone, would they need to add them at 51%? Or are you okay with them having less or 50-50 ownership?
Good.
Eric,
So-
just to let you know, Francine used to work for Chase, and she's the underwriter for Chase for over 25 years.
Nice. Yeah, no, it's great. And we actually, we have a pretty strict underwriting on our loan. Some originators like me might say too strict, but it's yeah, we appreciate, and obviously our investor and capital partners appreciate that. So to answer your question, anyone, how do I answer this? Okay, our guarantors on our loans need to have at least 20% membership in the LLC, and that a total of 51 or more percent in the LLC needs to be the guarantor. So if you got two members, one's at 49, one's at 51, the 51 is both could be guarantors, but why would you do that? 51% person would be your guarantor. The 49%, they'd have to sign a resolution via DocuSign. They don't have to show up to the close. We're good with that. You mentioned something that I'm going to caveat a little bit. Managing members or managers of the LLC, not to get too far in the weeds, but if say number 49, that person is the manager of the LLC and 51 is just a member, we would want to have some kind of resolution in the entity, not necessarily transferring, but adding our 51% as a manager that way, because we always want to have, if there's a manager, and they don't all have managers, but if there's a manager, we want that a manager to be a guarantor on the loan. Now, transfers and those types of things, we make it relatively simple. It used to be a lot more simple. Now we're requiring basically just a bill of sale. We want a new operating agreement that shows the new 51-49 split, and we want a bill of sale that says that Sally sold Joe 2% of their membership for $1, and they both sign it. Something simple like that, just to have that kind of path and trail.
Perfect. Thank you.
Yeah. There's a message. Let's see. You only do flip and renovation loans. How about rent ready house? Actually, no. So that I keep talking about DSCR. That rent ready. You can purchase a house that is stabilized or occupied as a rental already, and we can fund that. That's the 80% purchase. If the house is owner occupied in really good shape, the owner's selling it, they're moving down to Florida, you're going to buy it and rent it out. If you're not doing any work to it, same thing. So we can go either with that short-term fix and flip, or if the property's ready to go, then we could do that as well.
Let me jump in right here. How do you fund Airbnb? There's a lot of this type of property coming up.
So Airbnbs are a little challenging right now. We're getting a little bit more comfortable with them. Let's call it a year or so ago. In fact, I think, Alan, you and I worked on some of these short-term rental properties. If there was history in the property as an Airbnb, then we could underwrite it based on that Airbnb income. So remember that ratio, that rent to expenses, the rent number would be the Airbnb number. Last year, during COVID, it seemed like everybody bought Airbnbs, right? Palm Springs is a huge vacation area here in California for Los Angelinos. You can't swing a dead cat without hitting an Airbnb now. So there's a lot of supply, and the concern was, and kind of still is, that there's too much supply in certain areas, and that the value of those Airbnbs, the income, is reduced. Obviously, that's not the case everywhere, but we pulled back. We're opening it back up again as we get more and more data that's not COVID centric. Again, during COVID, real estate was anybody can make money in real estate, kind of. Airbnbs, we want to see that they're actually producing income. So right now, the way we're handling it is we'll do the loan. It will be underwritten based on the expected long-term rate. So we'll get the appraisal, and the appraiser goes in and they do comps and everything as though it's a one-year rental. and we can underwrite it based on that. And there's usually a leverage reduction associated with, again, so we're a bit cautious right now on those Airbnbs, especially for people that have never done it before, or if the property was never an Airbnb, then we're a little bit more strict on that.
Got it. Anyone have any other questions that you would like to talk to Eric? I know that it's well, probably you hear from Eric. There's a lot of things that we can do, ranging from fix and flips to. Well, by the way, do you still do construction, Eric?
Yeah. Oh, thanks for bringing that up. Yes, is the short answer. For our construction program, it's think of it as an infill program. We're not going to do, and I know Alan, you do. We're not doing the big developments. So somebody buys, a couple acres, they get it permitted, they divide it up into lots, and they are building houses. It's really not going to be us. Ours is better when it's it's downtown Philly. Somebody, looks at, buying a rundown place, they tear it down and they build up a brand new place. We can do on those all the time. So call it like urban infill is really the best way to go on that. Those programs tend to be more appropriate for someone that's done those before. Sometimes we can get a developer contractor that has done ground ups for other people. They've done dozens. They can point to different projects. They can show that they've done the work, but maybe they've never been on title for themselves. We can sometimes get those through, but we love to have it if the person has had skin in the game. If they've been on the line, they're on title, they're the ones that are running the deal. Obviously they may not do it themselves. They may be hiring contractors and everything to do it, but the rates on those, and we didn't talk much about the fix and flip or the ground up rates. Right now, you got to think double digits. We're in the, again, credit, experience are the big drivers and the deal itself. But by and large, think 10.5 to 11.5%, somewhere around there. Now, it'll be interesting to see right now, given the rate increase, the market is still digesting, and it usually takes a day or so. Like the Dow was down 500 points today. Yeah, it'll probably be up tomorrow. The 2-year Treasury was up a lot. It's probably going to come. So we're going to see what happens, and then we may adjust rates accordingly to that. So I guess stay tuned as far as that goes. But we're excited.
Okay, good,
Yeah.
good.
Restaurant, beauty supply, heavy equipment. Yeah, that's not going to be us. For us, it's all residential. So I know Alan does those, but for us, it's got to be someone's got to be living in it.
Yep, restaurants, beauty salon, heavy equipment. Go to your website under products, and you will see many of these different type of fundings. And I think you are talking about restaurant, beauty salon. You're talking about working capitals. So again, yes, we do fund those. So let's focusing back on 1 to 4 unit. Eric, let me ask you. Let me see if I have it. Let me ask you another question. How do you fund somebody purchasing a single family home, not for rental, but for their own daycare business, for example? So I run into a few of those.
Yeah. In general, we don't do it because while it might be a single family home, it's not a residential property at that point. The use is commercial. And at that point, it's not our, we could do it. There's nothing precluding us, but it's not our specialty. And we're trying to stay within our lane there. So, and people have asked too, mixed use. There's 5 apartments above and a shop on the ground floor. We can do those. A little bit restricted on square footage and rent roll associated with the commercial versus the residential properties, but those are certainly fair game.
Absolutely. Now, how about, well, this happened in New York. I'm not sure other area, but in New York, it happens all the time. People purchase a single family home and they rent it out by rooms.
Right. It's called, single room occupancy. Back in the day, SROs were flop houses, right? It had a bad name. The short answer is we don't do them because they act more like hotels almost at that point. Now, what's interesting is, and we're trying to make inroads, the co-living situation has come up a lot more. In fact, a friend of mine moved to New York from LA, and he lived in a place in Brooklyn that was a co-living. The apartment complex would rent out a suite, and each room was, it's almost like college dorms, right? Each room was rented out separately, and then they had a communal kitchen and bathroom and everything. Fantastic program. Doesn't work for us. We're treating those condo-tels are another thing where somebody, if you've heard that term, it's usually in Florida, where you buy a unit in a building, and when you're not there, you can let the management company rent it out for you, and they treat it like a hotel. That unfortunately doesn't work. Assisted living, similar, where either it's a complex or I think of the old Victorian homes that have all the bedrooms and stuff, and great programs. I know they're out there, but and in our terms, it kind of pains me to say this as far as the commercial side of things, where Wild West, anything goes. Still, we want to see some structure around a long-term lease. Fix and flip project where the zone, you can change zoning. Somebody might take a single family and split it up and make it a duplex, as long as they get the permits and everything, and it's legally allowed in that area. Sure, that works for us. But if they're going to split it up and rent certain rooms and stuff, that unfortunately doesn't work. Looks like there's a chat here. LLC members just looking for fix and flip in Delaware. That's interesting. So a couple things to unpack there. So the question was about a fix and flip, fix and rent properties associated with certain specialty kind of rental. In this case, domestic abuse, women's shelters. I've had that kind of a situation come up. The challenge there is, again, you come up with a single room occupancy issue as far as we're concerned. I'm sure Alan's got other outlets for those kinds of loans. For us, the loan has to be the renter has to be an individual, not a company. I've had corporate rentals, the same thing. If you can get it in the name of an individual, we're okay. But again, in this kind of a situation, it's a wonderful program. It just doesn't work for our rental or for our programs.
Yeah, that will go into a commercial loan. That's for sure.
Yeah.
Okay. There's another question for you, Eric. He's in a college town. He wants to buy a house that he live in but rent out the rest of the rooms. I would think that this is still primary residence then, right?
Yeah. Unfortunately, again, multiple rooms, there's an issue there, but you can't live in it as far as we go. Even if it's like people are doing house hacking, it's called, where they'll buy a duplex, they'll live in one side, rent out the other one, earn money, then finally rent that one out, buy another property and do that over again. It's a great program, but there's a restriction for us. We can't do it. It's too close to a consumer loan, and then you run into the regulatory issues.
Yep.
So that'll run afoul of our licensing, unfortunately. Someone mentioned co-op as well. Co-ops in New York. We have a couple. They're not called co-ops. There's another name for them out here in San Francisco and LA. But co-ops are hard. I've not done a co-op. I'd have to go through our guidelines to see. The problem with the co-op situation is you're not buying a unit. Well, basically, the problem is it's tough to foreclose because you're not buying the specific unit like you are in a condo. You're buying shares in a corporation that owns the entire building, and you're given a certain square footage of that building that happens to coincide with the walls of your unit. That's a hard thing, and it's become difficult. So no, unfortunately, we don't do those.
Yeah, but we do have lenders that do co-op. But unfortunately, just like Eric said, many of these lenders, they don't just want to fund one co-op. But if you're talking about entire building, you want to do a co-op on the entire building, yes, we have quite a few lenders, especially in New York. We have some good lenders that specialize in doing co-op, and their rates are very, very low. Last time I checked, probably not this year, but last year I was checking on the co-op, and their rate was still at 3%, 4%.
Yeah.
very low. But again, it's not easy to do. There's only a few lenders that can do something like that.
Because it's more like a commercial loan. Commercial loan, I mean, they're all commercial loans, but a true commercial building loan is a bit structured. Usually not. Our loans are all 30-year fixed rate, fully amortizing, just like a regular mortgage. Commercial loans, because I used to trade bonds, they're more like 30-year amortizations, but it's a balloon period, 5, 7, or 10-year balloons, and there's harsh prepay penalties associated with them. But yeah, they're quirky and interesting.
Right. Francine, how about you ask the last question?
Yay, thank you. Eric, I know you mentioned earlier the DSCRs, and that is a non-QM product, but how about other non-QM products like the bank statement loans? I'm also really familiar with the condotels, which are in Las Vegas. They're in Las
Right.
Vegas and have actually underwritten quite a few of those as well. So what other, non-QM type products other than DSCRs?
So you mentioned bank statements, and that actually brings up, so our program, our DSCR program, probably incorporates a few of what you're referring to. We don't require bank statement. I'm sorry. We don't require W-2s. We don't require tax returns. Actually, we've just changed our liquidity requirements now such that in a cash out situation, if you are willing to prepay the payments up to, I think it's 9 months, I don't even need a bank statement from you to fund that. So really all I'm looking for from the borrower, from the guarantor, is a credit report, background report. And in that case, just get the insurance policy. I'll run the appraisal. We do require an appraisal. It's got to have an internal appraisal. Tax certs, flood cert. That's kind of it. The bank statement really is, if there's not enough liquidity in the deal, if there's not enough equity in the deal, then yeah, I'm going to need to see a bank statement that covers. But I'm not collecting. Typically, I'm not collecting interest reserves or anything. And as far as sourcing in the bank statement, it kind of depends. Anything under $10,000, typically, I'm not concerned about for deposits. I just need to see, if it's not in your personal account, show me a business account with an operating agreement that says that you're a member or a shareholder, and we're usually good with that. If it's $10,000 or more, I want a letter of explanation. If it's a transfer from one of your other accounts, show me that bank account that shows that it went out from here and it went into there. But that's kind of it as far as that goes.
So what is the maximum loan amount?
So on the DSCR loan for a 1 through 4 unit, in the box, so no credit committee review or management review, $3 million. I can go up to $7.5 million with management review. On the fix and flip side, it's $2 million in the box and $5 million with management review. And there may be leverage reductions at those higher dollar amounts, meaning you're probably not going to get 80%, but maybe a 70 or 75% there.
Right. Perfect. Thank you, sir.
Yeah. And minimums, by the way, for you people that are in lower cost areas, our minimum property values on the DSCR loans is $100,000. So unfortunately, I get quite a few people that own rental properties, let's say in Dayton, Ohio, and they own single family homes that, are worth $65,000 and they cash flow like crazy. And they're like, just, let me lever it. I can't do it, but $100,000 or more, I can do those all day long. On the fix and flip side, I can go down to 50. So if the property's worth 50,000 today, as is, and worth at least 75,000 once it's completed the renovation, then we can lend on that on the fix and flip side.
Okay, great. Thank you so much, Eric, and everyone who participated tonight's training. This is another episode for Sequoia Lending. So as you know, a few years ago, when people buying investment properties, they just go to a local bank, go to a local mortgage company because yes, their rate is absolutely better However, they do require a lot more documentations. They need to look at your income, debt to income ratios, tax returns, so on and so forth. But because the interest rate is a lot better and they are willing to go through the hassles to get that low interest rate. But however, today is totally different. Many of their rate is not as any better than a commercial loan, but still they are looking for a lot more document than before because again, the underwriting guideline tightened up a lot more. So it is very natural for many lender or real estate agents or mortgage loan officers start to look for some other sources to fund their deals. So absolutely makes a perfect sense for people to come to commercial lending. And now, ladies and gentlemen, it is your job to go out there to talk to your community. You are a loan consultant. You are a commercial loan consultant. You can fund this project out there. You can fund all these properties out there. So talk to your real estate agents. Let them know if you have a client, hey, come to me. I do not look at income. I do not look at who they are. I mean, as long as they set up an LLC, I can fund that property as long as that property can satisfy the DSCR. Talk to your loan officers and let them know any deals that you cannot close, come to us. Our processing is a lot less. It's a lot easier than the bank today. Okay. And
I will say, just to interrupt you, Alan, guys, you know, I talked a lot about my specific programs and guidelines and in the box that I live in. I regularly bring Alan deals that I can't do. So, you know, he's legit. Really use him as a resource. There's untapped money out there to be made. So take advantage.
That's another things that, ladies and gentlemen, talk to your bankers. Okay, talk to your bankers. A lot of your banker right now cannot close deals and they have to look for another outlet. So kid you not, and let me give you this news, okay, kid you not. Many big banks out there are stop funding commercial projects. For example, Wells Fargo is not funding commercial anymore. Bank of America, they're not funding commercial anymore, even though they're saying that they're still taking into it, but it takes them like month and month and month, and they still cannot close it. So again, talk to your local bankers and they can send you a lot of deals. So ladies and gentlemen, that's another episode of Sequoia Lending's training, and go out there, generate deals and make a difference and disrupt this industry. So thank you so much. And
Thanks everyone for coming.
Thank you so much, Eric. We see you next week.
Bye.
Good night.
Thank you.
Thank you.